Hey everyone, welcome back. Smash Property Podcast. Today's episode is all about tax benefits for property investors. Now, what if I told you that the tax system can work in your favor as a property investor? And this is not just about negative gearing. There are multiple layers and multiple tax benefits that investors can potentially get from investing in property. Now, today we're going to break down the key tax benefits from the basics all the way through to the advanced strategies like trusts and self-managed super funds. Before we get into it though, none of this is tax advice. I am not an accountant. I don't give financial advice. I'm a property investor and a buyer's agent. And I've been in the game for quite some time now, building my own property portfolio over the years and now obviously helping out clients do the same thing. If you get some value out of the video, I appreciate it if you could like the video and consider subscribing. We release content like this almost every single day for property investors. Now, we're going to dive straight into it and we're going to talk about the first benefit, which is often the most talked about, and that is negative gearing. Now, the definition of negative gearing is where the expenses exceed the rental income for the property that you have, and that loss offsets your taxable income. Now, the benefit is this reduces your taxable income at your marginal rate. So, for example, if you had a $100,000 salary and you had a $10,000 loss on a property that you own in your personal name, your taxable income would then be $90,000. It's literally that simple. Now, to clarify, I often hear tax professionals, accountants, pushing this as a property investing strategy. This is not a strategy for investors, right? You don't go and buy something to make a loss at it to reduce your income to get some of it back on tax. This is not a way to invest in property. It's more of a side benefit that you get out of it. This is no way to scale a property portfolio. It's no way to build a scalable property portfolio and build wealth over time. It's just a side benefit that you get out of it. Now, I'm going to get into what you can claim in terms of other expenses on the property a little bit later on in the episode, but I just wanted to clarify the definition of what negative gearing actually is, and it's just quite simply expenses exceed the rental income. The difference, you offset your taxable income and reduce your taxable income for that. Interestingly, I don't know why people push this as a way for investors to invest in property. It just does not make any sense to me as a property investor. But like I said, I'm not a tax professional, guys, so maybe I'm missing something. We don't claim to know everything here at SPI. This is all a big learning journey as well. So the second, probably most common benefit, I would say, is depreciation. Now, depreciation schedules allow you as the investor to claim things on the property that, I guess, get run down, worn out over time. Now, this is best suited for newer styles of properties. There is a point in time with the age of the property where depreciation just, you can't do it, or you just don't get the benefit out of that with an older style property. This is one where, for example, if you had a brand new build, you would order a depreciation schedule. This is where someone would go through the property and do what is called a depreciation schedule. Now, this is best done as soon as you take ownership of the property, and then your accountant will then be able to use that depreciation schedule over time to allow you to reap some tax benefits here. Now, this is often what a lot of investors overlook, is actually ordering the depreciation schedule, getting it done as and when you take ownership of the property. So for example, if you had a $500,000 property, you had a depreciation schedule done, there's potentially 7 to 10 grand, and I'm just using airy-fairy numbers here. It won't literally be that, but as an example, 7 to 10 grand a year, you would be able to deduct yearly for a period of time. Now, you do need the quantity surveyor report, like I mentioned, the depreciation schedule, in order for your accountant to actually do that. So you can't just rock up to your accountant come tax time and be like, let's do depreciation. You've got to have that report essentially done prior so that your accountant can execute on that for you. So negative gearing, probably most popular one. We hear it quite often. It's often talked about in the news. They're going to scrap negative gearing and all this sort of stuff. Depreciation is often one of the second biggest, I guess, tax benefits that is often spoken about, talked about among property investors and people alike. The deductible expenses, let's get into that. This one is, I think, often surprises people with what you can actually claim as a deductible expense on the investment property that you have in your personal name. Now, just to clarify, you cannot get negative gearing on a property If the property sits inside of a trust or a self-managed super fund, it is only beneficial if it is in your personal name. So what can you claim? The interest on the loan that you have attached to the property is something that you can potentially claim as a deductible expense on the property. Note the interest, not the principal repayment that you have, which is a large part of the reason why a lot of investors, including myself, just go interest only on their investment property loan, largely for this reason. And for me, number two, it's a little bit cheaper in terms of the actual repayment. And then I use that difference that I'm not paying the principal back and use that to either pay down debt or to go and buy another property with it. So loan interest is one of the biggest ones you can claim as a deductible expense. Property management fees, I would always encourage you to get a licensed property manager to manage your investment for you, regardless if it is in your same city or state or not. But property management fees is something that you can claim as a deductible expense, as well as things like maintenance and repairs. You can claim as a deductible expense on the property. Insurance, council rates, strata fees, these are all things that you can claim as a deductible expense at the time of filming this video in 2025. Travel expenses, you cannot claim for individuals anymore, but for some trusts and companies in certain cases you can. So if the property is in your name, I think it was about 2017, the ATO got rid of that little rule. People were taking advantage of it. They had a property in Queensland and they would take a family holiday, go claim a bunch of stuff. Cannot do that if it's in your personal name. I've never claimed travel expenses for my properties, even though some are in trusts and companies, but I just steer clear of that. Now, this is important to maintain your records and receipts so that your accountant can do this effectively and legally for you when it comes to lodging your tax return at the end of the financial year. This is again why a property manager there's many benefits to a property manager, but one of them being is that they will often manage all of those expenses for you. For example, if you had maintenance, they might order the trade to go out to fix the property, plumbing, electricity, whatever it is. That will all be on an end of year statement that you will receive from your property manager, which you can then use to give to your accountant so they can then claim everything properly in order and legally as well. I do that, but I also keep my own records as well. I just like to do it. I know you don't need to, but every month, I basically would take the statement from the property manager. I've got an Excel that I put all the numbers into, and so I can see on a monthly basis what the actual cash flow looks like of my property. So I take the rental income, put in all of the expenses, including the loan, everything else, and then it tells me if I've made a profit or a loss on the property each month. I think it's good to do that because after all, you're investing for a financial gain and a financial benefit. If you're not tracking this like you're running a business, then it's not there's what's the point, but in my opinion, you want to be on top of it more so than just doing it once a year and then going, oh, the property cost me 15 grand this year. I like to know that on a monthly basis, but that's a separate topic. Maybe I'll show you how I actually do that in a later episode. So those are just some of the deductible expenses, the most common ones that you can claim on a property that you own. Now, let's talk about capital gains tax. Now, this capital gains tax at the time of filming this is applied on the sale when a profit is made from the property. Now, you do get a 50% CGT discount if you held the property longer than 12 months. For example, if you made a $100,000 profit, only $50,000 of that is going to be taxable, and this gets added on to your taxable income for the financial year. This is where, and this is a strategy tip for you, aligning the timing of the sale of the property with potentially lower income years or stagger sales out. So don't sell them all at one hit. Maybe you might want to do that over a number of years. And this is where having an accountant who is a little bit more strategic can be of a major benefit for you so that you can actually pay the right amount of tax, but not leave a tip for the ATO, to use one Kerry Packer's. Kerry Packer? I think he might have said that in one of his speeches to Parliament many years ago. Yeah, CGT, and I might just clarify here, I didn't realize this until recently actually, it's the CGT is added on to your overall income for the financial year that you sell the property. It's not like a separate tax, and it is only on profit. right? So that's important to keep in mind as well. Let's talk a little bit more now about advanced structures. Now, I'll just repeat. This is not financial advice. I'm not a tax accountant. This is not tax advice in any way, shape, or form. I've got properties that sit inside of discretionary trusts as well as super funds. I've also helped clients buy properties in both of these structures as well. So this is talking from my experience with it. I'm not giving you advice on what to do with your money. Please speak to a qualified professional before you do that sort of stuff. And if you are enjoying the video, give it a thumbs up and consider subscribing if you haven't already. Shameless plug. I never used to do that, but I feel like I've got to these days. And anyway, actually, side note, if you haven't noticed already or seen, we are a finalist in the REB Innovator of the Year Awards in the Buyer's Agent category, which is a huge thing to be a part of. Just being a finalist is a big achievement. Smash Property Investing is, we're on our way to the top. Shout out to the team for getting us there and doing all the work. So let's talk about trusts first. Now, this is where you have a property that is owned by the trust, managed by a trustee, in which the beneficiaries receive income. So I've spoken on previous podcasts about the pros and cons, the benefits of discretionary trust, but the high-level benefits is you get asset protection, you get the flexibility to distribute income to lower tax family members potentially, or into a bucket company if a bucket company is listed as a beneficiary. And there's also some estate planning benefits that you can get out of having a property sitting inside of a discretionary trust. Now, the limitations with it, I've said it before, it is quite expensive to set the thing up. Not only to set it up, but also to maintain it as well. Some banks just won't look at you if you have a discretionary trust. Some banks might want guarantees, all that sort of thing. However, some banks also make it a little bit easier to borrow money as well, depending on the property type. You might pay a little bit extra for it. But with this, the biggest, call out as it relates to the tax side of things is that losses stay inside of the trust. So if you had a property that was where the expenses exceeded the rental income, you can't claim that loss against your personal income tax. It does not work that way. So this is good. Trusts are only good for investors with larger portfolios, right? You've already got a couple under your belt already, or you've got a reasonably high income. I'm talking well into the hundreds, many hundreds of thousands of dollars, who want that tax flexibility. This is not for, you don't have a property yet. I wouldn't even entertain the idea of getting a discretionary trust. I only set up a trust, I think I was 5, 6, maybe even 7 properties in before I actually got and set up a discretionary trust. There are a lot of benefits to it. Maybe check out the other video I've done on trusts and a little bit more information in that video. But yeah, it's more of an advanced strategy. Now, self-managed super fund. Sorry guys, my nose is a bit runny here. We are in the middle of winter. It's a beautiful day here in Sydney. It's been raining a lot. I've been also traveling a lot as well. A little bit worn out, but that's not your problem. That's mine. Self-managed super funds. Now, this is a great one. If you have a balance, I would say north of 150 grand in your personal, is in your industry super fund or wherever your super might be sitting. If you've got more north of 150K there, I would highly recommend speaking to a tax professional accountant about setting up a self-managed super fund. Or you might not have 150 grand, but you and a partner or you and multiple family members might, and it might allow you to get into the market that way. So this is where you basically take the money that's sitting inside super, you set up a self-managed super fund. So you take the money out of the industry super fund, you take control of it. It sits in a bank account that you can see, you can log in and see it all. And then you use that money as a deposit to go and buy a property with it. And you can do this with up to 6 family members, or up to 6 members. They don't need to be family. Now, this tax environment is an amazing place to be. And in my opinion, if you could buy all your properties inside of a self-managed super fund, I would highly recommend considering it. Again, the reason is tax is capped at 15% on rental income, which is amazing, right? The 10% capital gains tax applies if you've held the property for more than 12 months. And there is potentially 0 tax when you reach pension phase. You say if you're in your 20s, 30s, 40s, 50s, whatever, you buy a property, you hold the property up until pension age, you reach pension age, and then you sell the property. There's potentially no tax you're going to pay on that. Potentially, depending on your situation and also the rules at the time of you doing that. There are a lot of restrictions with this though. It's got to be for retirement benefits. So you cannot buy property inside a self-managed super fund and you can't go and live in it, nor can your family members live in it. It's got to be, so there's no personal use with it. Borrowing is a little bit tight. Your major lenders are not going to touch self-managed super funds. This is going to be where's my self-managed super fund? I believe it is with First Mac. The bank account's with Macquarie. First Mac has the loan for that. So you might need a higher deposit, 20-30% potentially. You might pay higher fees with it, but when you weigh it all up, my opinion, it is a massive benefit to have a property inside of a self-managed super fund. Compliance costs and admin, it is high. Like it's going to cost you 4, 5, maybe 6 grand to set the thing up. The ongoing admin costs are going to be quite high. And of course, the money's locked in there until you reach retirement. It's going to be locked in there anyway, because even if you had it sitting in an industry super fund, you can't touch it until you get to retirement age anyway. So in my opinion, why wouldn't you want to just take control of your own cash and decide where you want to go? The other cool thing is you don't just have to buy property with it. You can invest it in pretty much anything, so long as you can justify that it's not a personal thing. I've seen, I've heard of people buying gold, buying classic collectible cars, so long as the storage of it and the use of it, all those sorts of things, is not for personal use. Speak to your accountant before you go in and do anything crazy like that. But it doesn't have to just be property, which I think is the coolest thing. So again, this is good for investors that have a large balance. Often they say about 200 grand or more. I reckon you could probably get away with doing it with about 150. And again, that doesn't mean to say you need to have 150 grand. It could be you and 6 other people that you pull your funds together with, right? A great way to get in. And you might be sitting there and you might have one property. You might have a couple of properties and you might be stuck with serviceability, or you might just not be able to get a deposit together or whatever it might be, but you've got all this cash sitting in super. It's a great way to get another property. That's literally what I did. Like I said, I think I had about 6 or so properties in my personal name, decided to do a discretionary trust, got the right property, which fully paid for itself. And then I was like, I've got a big balance in super. Let me go and set up a super fund and get another property. So it just allows you to continue growing your portfolio just a little bit further. So highly recommended if you haven't done that already. So look, overall, there are a lot of tax benefits, incentives for property investors. Now, in my opinion, the tax benefits are a bonus. It's not the foundation of a good property investment strategy, right? Like I said at the start, I would never invest purely for the tax reasons. I'm investing because I'm going to grow my wealth over time when it relates to property investing. So the wealth comes from the growth. The cash flow allows you to retain and to continue growing your wealth. And smart tax management on the side allows you to continue doing that in the most efficient way without leakage and just unnecessary costs and expenses that you're going to otherwise wear along the way. Always seek advice from a property savvy accountant. So don't just go to your cheap accountant because it doesn't cost you a lot to get your tax return done. I was one of those people. I actually did my own tax. I had about 4 properties and I was doing my own tax because I was a tight ass and I didn't want to pay for an accountant to do my tax for me. But after doing it with an accountant, I'd highly recommend getting someone who's a property savvy accountant to do that stuff for you, because there's a lot of stuff that if you're not an accountant and a professional one at that, you're going to miss stuff, right? It's like with a lot of things. We can do it ourselves or we like, but the reality is if we're not professional and trained in it, we're going to miss things like I did. So don't skimp out, pay the couple $100 or a few $1,000s, whatever it is, to get someone professional to look at it. And I just want to close out because a lot of people, I see comments online where people seem to think, for example, with negative gearing, that it's costing the taxpayer, right? It's not costing the taxpayer anything. Nothing is coming out of your pocket into mine when it relates to negative gearing. It's the investor reducing their taxable income. Sure, you could probably argue it is costing the taxpayer because it's otherwise revenue the taxpayer is not receiving, but nothing is coming from the taxpayers into the investor's pocket. Just want to clarify that because a lot of people get mixed up with that. So Negative gearing, depreciation, deductions as it relates to expenses of the property, capital gains, tax, discounts, or things that we need to pay attention to with the trusts and the self-managed super funds. There is a lot to it. This was just to sort of breeze over some of the things that we need to think about and pay attention to. But again, don't buy a property just for tax reasons. I saw an accountant the other day saying, and it drove me nuts. She was saying that her advice to her clients is to buy apartments so that they're negative. I just had a brain meltdown. I won't even go into it because it's just silly, but don't buy it for tax reasons, please. Buy it because it stacks up as a solid investment. Buy it because it's going to grow your wealth over time, or buy it because it is going to put money in your pocket. And then the tax benefits, they essentially just amplify your results. Think of it like that. So if you want help building a plan and a property portfolio that works in real life, not this random YouTube advice or whatever, we'll help you get it done and get it done the right way. Everyone that works at Smash Property Investing is a property investor. We've gone and done this ourselves, and now we've got countless runs on the board with many clients over the time we've been operating. If you want help on your specific journey, reach out. The details are in the description below. You can book your call at a time that suits you. We don't have anything to sell you, right? So this is a chat to work out what is it that you want to do, and can we help you actually do it? We'll never take you on as a client if we know that we can't help you. We'll just simply turn you away and say, hey, sorry, we can't. But yeah, it doesn't cost you anything. Link is in the description below. But once again, if you got some value out of video, appreciate it if you could like it and consider subscribing. My name's Nick V, the director of the Smash Property Investing Buyers Agency. Thank you so much for watching. Until next time, catch you soon.